Hello everyone, welcome to episode 18 of the podcast. My name's Jamie Sexton, Head of Centralised Advice, and today I'm joined by an extremely exciting panel of guests. We've got a couple of newbies on here. I'm joined by Mr. Earl Glasgow. Earl will introduce himself in a second. Simon Wigdahl, one of our wealth management partners.
Hi.
You'll be familiar with Chris Leyland. He's many times on the videos. And Rebecca Wright, Head of Centralised Advice. So, morning everyone. Earl, I don't know if I can start with you, please. Can you just give us a little bit of an introduction on yourself? Tell us what you do at True Potential.
Thanks, Jamie. Well, I'm one of the group senior partners, Enid Blyton's famous 5. I think it was 5, but might have been 6. I haven't read the books that well. But I joined I've been working with David now since 2001. 33 years in the industry, 14 Prudential, 19 with David, 13 with True Potential. My speciality in the group is trying to find good advisors, acquire good clients, and just generally anything that's got to do with distribution and sales. My claim to fame, by the way, is I'm still a qualified advisor, not as good as Simon when he introduces himself. I've just got my fellowship in the PFS.
You're not doing yourself a justice there, Earl. You're not doing yourself a justice. That's the highest qualification you can have in the CII. So that's a pretty good qualification to have.
But unfortunately for me, it was a lifetime's work.
And Earl, the keen listeners will be able to hear that that accent isn't from this side of the water. Based in Northern Ireland. What's the lockdown been like over there?
Well, we've had a wee bit longer. We're still locked down apparently, but when you go out onto the street, nothing looks locked down. So I don't know. It's a bit like Chris's place where you need to lock everything down. But anyway, in terms, not worry about that.
Chris, that only took 2 minutes for that joke to come out.
Quick, wasn't it?
Oh, I know I was nearly going to wait till we talked about pension transfers, but we didn't bother. But no, we've got. I think we're run the same as the UK, Jamie, but it's a bit difficult to understand all these different governments and different sectors, and so we're easing the lockdown as well. I think big difference is the schools are not going back to September, so there's a row on about that at the moment. You're allowed at the garden centres. I've never been in one, so that's not an outlet for this weekend for me. But it's I think what you'll find is my accent's got worse because I usually get to England 4 days a week to get posh. Well, now locked down here since St. Patrick's Day. No one will understand a thing I'm saying for the next hour. So there we go. We'll have a bit of fun.
We'll try. We'll maybe get some subtitles on there, Earl, if we can.
Please.
And speaking of keen gardeners, we've got Simon on here. Simon's one of our True Potential wealth management partners, so he's an advisor in the field. Welcome, Simon.
Thank you. Thanks, Jamie.
Let our listeners just know a little bit about yourself and how you've been getting on during lockdown.
Yeah, sure. So Simon Wigdahl. I'm 42 years old. I live in York. I'm married with 3 dogs, one son who's 11. I've been in the industry 22 years, which I know is hard to believe, but I have. I worked for a few insurance companies, and then I was an IFA for 10 years, and then I joined True Potential 7 years ago, which has been a great move. Very happy. Got my own money on the True Potential platform, and been very happy with all that. And with lockdown, I've been speaking to clients. Clients seem to accept that we're all in this situation together. Obviously, it's not very nice for some people. Some awful news coming out, but there's good sides of this, and I think I found my clients have been happy that. Nice to have been kept in touch, and they're glad to hear from me and some reassurance.
Fantastic. What's your top tip, would you say, Simon, for other advisors that potentially are listening in terms of communicating with your clients? Are you using the likes of Zoom or Teams or what's up?
Yeah, a lot of just simple staying in touch in general. Phone calls have been great. But I have used some video meetings on Zoom. I tended to use for whatever reason. I found that quite easy to use, so that's been good just to see people. Just really getting in touch. So Zoom meetings, phone calls, just nice. Very grateful to hear from me, I think, and nice to speak to someone, because with it being a lockdown, you don't speak to that many people necessarily outside of your maybe close family. So yeah.
Good stuff. Thanks, gents. So the podcast today is going to be focused around pensions. So that's the reason why we've invited some pension experts across. But before we get going on them pension questions, I'm just going to ask Chris to give us a little bit of an update on quite a positive market this week, Chris.
Yeah, thanks, Jamie. Good morning, everybody. No, Jamie, you're exactly right. It's been a really strong week for equity markets. Seen the US up around about 2%. UK reached and broken through that confidence level of 6,000 for the FTSE 100. So the UK is up around about 5%. And big winner this week is Europe, but particularly Germany. So France and Germany put together a 500 billion euro stimulus package, which has been taken really well by the market. So I think right now there's different factors at play when you look at equity markets overall. I think firstly, news around the coronavirus, news around a potential vaccine. I think secondly is how the lockdown is panning out, but particularly how the lifting of the lockdown is panning out overall. And I think the third thing really is around government stimulus. I mean, what's just been absolutely incredible is that the government and central banks have been there and determined to do whatever it takes to prop up the global economy, to keep that liquidity within stock markets overall. And because they acted so quickly and they acted so strongly, that's why you've seen that big rebound. So if you think what bottom of equity markets was, I think it was something like March the 22nd, you're up, over 20%. So you've seen what's been an incredible rebound, but it's because of all that action that has taken place. But I think what's particularly pleasing for me is that governments and central banks are indicating that they can do even more. I think outside of that, what's really interesting is UK gilt yields have gone negative. That for me is pretty incredible. It's something that you haven't seen within longer dated UK gilts. Obviously, that's something that we can potentially talk about a little bit later on when we talk around the pension side of things. But in some ways, you've got UK base rate at 10 bips. You've got the potential for the UK base rate to go even lower. It could potentially go negative. And obviously that then factors into overall gilt yields. But it's incredible times. But when you think about it, it is actually incredible times. The reality is we're all at home now during a lockdown, something that I've never seen before. But in some ways, I'm pleased with how the equity markets have reacted and that stimulus that's come through.
Fantastic. I think, Chris, for a question from me is, how would you say that the stimulus packages that you've seen, which you're right, I think we'll use that unprecedented word as everyone should use. How does that differ from your other sort of crashes that have potentially happened? Have we moved a lot more quickly from other sort of downward trends?
Yeah, no, you're exactly right. If you think about what's comparable to now, probably SARS in 2003, because SARS, it was a form of coronavirus, and it actually took China 3 months to admit that SARS existed. Okay, whereas this time what you've seen is they immediately came out, they said they had a problem, they said they had a virus, they immediately locked down as much of China as they felt they needed to, and then obviously the whole of China. But I think what you've seen is basically globally people working together, which is not something that you have seen so much before. I think there's a reality that, lockdown is the way to get through this. And that's actually happened. And I think from a stimulus perspective, I was looking at the numbers, and I think so far it's $7 trillion, which is a pretty incredible amount of money that has come through from worldwide stimulus so far. But that's not necessarily the end of it. There's potential for more stimulus to come through as we move through this, as governments, central banks believe that the economy needs it. So I think for me, it's the first sort of crisis, if you can call it that I've been through where there's been such fast action, but such aggressive action.
Great. And I think, Earl, I probably bring you into this now, being the more experienced member of the panel.
Oh.
You most likely lived through a few of these crashes. Well, you probably lived through a few crashes, Earl. I don't know. What's your feel been for the last 6 months in terms of how clients are feeling and compared to sort of previous market crashes?
Well, I joined the industry, Jamie, in October 1987, right? Straight out of school into Prudential. And the job I thought I was doing was going around collecting money. And then I realized I had to talk to people and maybe sell some things to them. But the interesting thing was that Prudential back then, which predominantly industrial branch collecting, got involved with Prudential Holborn, which was unit trusts, right? And it was a baptism of fire, because what they just released in September 87 was the Prudential International Small Companies, which if you look, Chris will probably think, oh, small companies, stock market crash 87, you know. So I was, spent the first month or two going around farmers collecting their monthly premiums, being asked, why does this thing say 33p in the paper when it said 50 when it was sold? So yeah, it was an education, in terms of, how to deal with clients. And I think back then the thing was the same as now. It was, stay in your seat, right? History tells us that things will recover. A lot of the market is sentiment. So, I've lived through 87. I lived through .com in 2000, which was the .com bubble, which was, for me even worse, because on the back of that came the Iraq conflict in 2003, which hammered the market even more. We got out of that. Then we got into the financial crisis in 2008. And then we got out of that. And I think for me, listening to Chris gives me great heart from the point of view, when you look at the fundamentals, this is not an economical problem, right? This is caused by a virus. If we sort the virus and you look at the amount of work, that's why I back Chris. But like, what's the alternative? When I joined the industry and I was selling investments and selling asset-backed investment, I remember in 1992 the interest rate was 14%, right? So I was going around with my with-profit fund saying, great bonus is 11%, and the client would pull out their first trust or their Ulster Bank statement and say, well, this thing's paying 12, 13, right? And actually, I keep making the joke when I joined, and I used to tell people to sell life assurance. I used to read bars. I didn't have to buy anybody a drink. I'd look around, everybody had gone. I think I'd try and sell them a pension, right? Where you look now, right, and maybe Simon will testify to this, but anywhere I go now, and people ask, they're asking me, or do you do financial advisor? And I'd say, well, I try my best, but I've got 600 experts work for me, like Simon. But they're asking us now, what do you do with money? Because if you look at what's ahead of us in terms of, negative gilt rates, negative interest rates, right? Everything in life's a risk. The biggest risk now is not taking advice, right? And actually not talking to somebody like Simon, who uses the talents of Chris, right? That's the bit. So to me, it's time in the market. It's proper asset allocation. It's proper segmentation of your money. You'll need some for a rainy day, but you do need to back, the long term, back Chris. But it's always the same, right? It's always been there for the client to settle them down, and give them some evidence of why, and they'll thank you in the long run. I'm sure there's people came out of this market who got scared and have missed the bounce back, and that to me is a tragedy, because they don't have a Simon. They don't. Simon just explained very well what he's been doing in lockdown with clients. Those clients will thank Simon in years to come, because they've had the upside again. So anyway, I haven't even give you history there. I give you ancient history.
I'm worried now as well that you're going to start calling Simon my Simon, a bit like Simon Cowell and on Britain's Got Talent. So maybe Simon, I don't know if you can come across that and echo with Earl. Is that need for advice? Are you seeing that quite a lot? Are you getting many beers bought for you when you go to the pubs these days asking for help?
Well, hopefully, if we'll get back into a pub, maybe, yeah. But yeah, I'd echo exactly what Earl said. I've not lived through as many of the problems. So certainly the 2008-9, the 2001-2 are more recent memories where this is a different animal. But I do believe that, you know, things will recover, because before this happened, everything was quite healthy, if you like. So things will recover. We just don't know when. And like Earl says, what are the alternatives? But at least markets may go down a little bit further than where they are today. But what we do know is that if you invest in now, you're getting in a discounted rate. Markets are lower than they were, say, mid-February. And yeah, I think that's where the advice comes in. Where should I invest my money? So Chris takes care of like I said, the money is very well diversified, which I'm a big believer in. My part is the advice on the products, the tax advice really is where I sort of come in. And yeah, as I say, this is a different animal, but the advice I've been given is just to sit tight if you can. Don't take money out unless you really sort of have to, and it will recover. It has to. How long that will take is the unknown bit that I don't think even Chris could say, well, in 3 months it'll all be fine. We just don't know the time scale, but it will recover.
Yeah, as I was saying before, history tends to tell you that it does recover.
Yeah.
But I suppose moving on to today's topic, which is pensions. I think you know, when I speak to clients and I speak to friends as well, you know, you get that sort of phrase of a pension. Oh, that's I start thinking about that when I retire. When actually it's quite important to start thinking about it now. And Rebecca, I'll come to you first, because I know you look after the auto enrolment department, True Potential, and just give us a bit of a background on, I suppose, what auto enrolment is, what are the sort of levels of contributions, and how do True Potential help clients in that way.
So auto enrolment was brought in by the government a few years back now, and it was a scheme to get people saving, to get them opening up pensions, because as you say, your typical younger person thinks I'll get to that later on, I don't need that just now. So auto enrolment is a scheme by which workers are automatically put into a pension if they meet certain criteria, meaning the majority of full-time working people will be automatically enrolled. And it's then for that individual to elect to opt out of the pension if they don't want it. If you don't do anything, then you're actively going to start making pension contributions. They get deducted from your wages before you get paid, and your employer is going to be paying in as well. You also get the benefit of government tax relief topping up that pot. The percentages which get paid in, so it's based upon a worker's what we call qualifying earnings. So it's anything between just over £6,000 up to £50,000. And the worker's paying in roughly 5%, whereas the business is paying in about 3% of those earnings. And of course, getting the benefit of tax relief on the members' contributions as well. So that little bit's going in every single payday, coming off in a small segment from the workers' wages, and then topping up. We give every single member the facility to log in, to view their pension, to set goals, so they can start to see, is that amount that I'm paying in now really enough? Or do I need to be paying in a little bit extra? And our technology allows them to help figure that out. And if they do want to pay an extra, they can then go ahead and they can do that. A lot of businesses elect to pay a little bit extra as well. So we see businesses who do loyalty schemes with long-serving employees, paying a bit extra, perhaps instead of giving end-of-year bonuses. Some companies make top-ups into pensions and things like that as well. So it's a great way to incentivise staff if businesses want to use it in that way as well.
It's interesting. I think obviously auto enrolment's the opposite of what you had to do as a youngster when you first started selling pensions. We were talking about this yesterday, but I don't know if you can give us a little bit on that history of that, of how it's actually changed over the years, and specifically, I suppose, in the last 4 or 5 years with pension freedoms coming in. What's different from that? I
don't know, but I think Rebecca should be in sales. You've more technical knowledge than I have. I think that back in '87, Jamie, there was just what we called retirement annuity contracts, and mostly it was self-employed people, self-employed businesses, farmers had a pension, And then Margaret Thatcher, decided that we needed a portable pension. So in the first of, I think it was June 1988, we had a couple of big things happen in the UK. We had the Financial Services Act came in, which was formal regulation on the back of, actually it was a pension scandal, Maxwell and the Mirror, I think, if you remember back then. Yeah. And Mr. Maxwell, dived off a boat in Tenerife or something, never seen again, unfortunately. But they brought pension legislation in to protect, and they brought regulation in. But the other thing was portable pensions. And that was to give every employee the opportunity to save into a pension, as well as the self-employed, right? And that continued over the years. Now, when you were selling pensions back then, I remember when they would mature, right? People would always ask, I've saved up this pension, or, what happens if I die, right? Now, we used to build guaranteed annuity rates, and we used to build in, minimum terms of 10 years, etc. But back then, annuity rates were 12%. So, what you were saying to clients was, well, look, if you can hang around for 7 years, you'll have had your money out, right? I think the biggest change in pensions, because I think people fell out of love with pensions because they were seeing the annuity rates go down and down and down. So by 2015, when people would have asked you, I'm getting this pension, the annuity rates were maybe, you look in the Sunday Times, and maybe 2-3%. They're worse now. So actually, you'd have to hang around for 30 odd years to get your money out of the pension. I'm not saying annuities are the wrong thing. There's ill health annuities, and for people who want a mixture, they could get a guaranteed pension, guaranteed income from an annuity. But I think the biggest thing to happen pensions is pension freedoms. And certainly in my 33 years, I know what Simon thinks, from a product innovation, right? Actually, a pension's turned into something else now, right?
Agreed.
So it's actually a family heirloom. You can pass it on. You've total freedom how you take the benefits out of it. It's opened up the occupational defined benefit transfer market, because you have a lot more options to do. So I think if you even look at the inflows and the money getting into pensions now, as opposed to 5 years ago, pre-2015, I think a lot more people, because they've got access to the money and the ability to do something with it, and actually even use it for inheritance tax plan, will actually, because it's written in trust, it could sit there. You use all your other, assets, your house, you could take on debt, whatever, and you actually leave the pension there because it's outside your estate. So to me, I think it's a fantastic time for the like of Simon and even Rebecca, the way she can tell us all about them features. She should be selling pensions, in my view. It was a great time for pensions. And what I used to say to so young people years ago, what I used to say to young people was, every 5 years you wait, right, to start saving, right, you'll probably half your opportunity of income in retirement, right? Back in 1988, we were getting told that there wouldn't be a state pension. So I'd be telling the like of Rebecca, you need to start saving, because the government have worked out by 2033, they won't have any money to pay a pension for young people. And I would say to any young person, start early, because you're getting Chris's units or Chris's investment fund cheaper than you won 30 years time, right? And every 5 years you wait, you'll have to double your monthly contribution for the lost time, right? And I think auto enrollment's great, but that's a bit of a history of it anyway, Jamie. I think now pensions are beautiful. I don't know what Simon thinks.
I don't think I've ever had them described like that, but Simon, I think it's probably worth bringing you in here.
Yeah.
I from a client perspective, it's always something you get asked, which is, how much do I need to start saving now? So from a younger point of view, even going into sort of, how much should I be putting into my pension? I'm guessing you get asked them questions quite a lot. And how do you sort of deal with clients in that way? And what is the answer, I suppose? How much should I be?
Well, first of all, I agree with everything Earl's just said there. There is a cost of delaying, if you like. And also, I often say that the word pension, I really sort of don't use anymore, because it brings people associate that with something bad that you lose money with. So I don't use the word pension with classic. Just think of it as a savings plan for your future, but for your retirement. So because it has changed so much, much more flexible, as you know. And I often say that it's really the opposite of a mortgage. So with a mortgage, you are borrowing a big chunk of money and you're paying that off over 25, 30 years. And when you first get your mortgage, you think, crikey, that'll take some paying off. But you chip away, and eventually one day, hopefully, it gets paid off. A pension is the opposite to that. You're trying to save up a big lump of money. You get tax relief, as Rebecca said, which is a big help. Starting now is a big help because the units are lower, but it's doable, and you can achieve that goal. But you wouldn't try and pay your mortgage off in 5 years, just like you can't save for your pension in 5 years. You need to give it a long term, which is what, like Earl says, the sooner you start, the better, and even if it's a small amount. So, but back to the question of how much should you save, it's difficult. It's a difficult question to answer. A rule of thumb I sometimes use is to say, well, whatever your age is, use half your age. So if you've got no pension savings at all, half your age as a percentage of what you should be paying in. So if you're 20 and you're starting, if you could pay 10% of your wage in, that's not a bad rule of thumb, and it will always be 10% of obviously whatever you're earning. So that's one rule of thumb. A more sort of scientific way of getting a figure is by saying, well, what income do you require in retirement? So again, from experience, I often find that maybe it's sort of 75, 80% of what your expenditure is now, because many of the bills still exist. You've got your council tax, you've got food, you've got the gas, electric, and so on. Your mortgage may have gone, but other expenditure will increase. Like you might go out for meals more, weekends away, more holidays, and so on, because every day is like a holiday. So you can work out a figure, and again, we use, so if someone wanted £25,000 a year in retirement, if they could save £500,000, which is sort of 5% roughly, then that's not a bad rule of thumb. And then we work backwards, we add inflation onto that, and you end up with a monthly amount. So if you say X, that should achieve your goal with some presumptions about investment returns in. And you start from there. Again, something I always say, if you can join your workplace pension, a lot of people opt out, I've found, especially younger people. So I don't want that, but really they're throwing away free money. So it's important that if you're younger, you should definitely opt into the workplace scheme. And again, I've often said to people that are in a company scheme, if you get a pay rise or a bonus, that's the cracking time to increase your pension.
Yeah.
So if it's only 0.5% or 1%, but if you did that every year, it makes a big difference. Again, with the tax relief you get, you soon get there, and maybe treat it like a bill almost. It's all, you've got to pay for your, there's all these things we've got to pay for every month. Just think of it as another bill and forget about it, and the fund will grow.
And I've spoke to a lot of advisors who say that they've had, bring Earl in again, but you find that you've had these clients for maybe 10 to 20 years, and they'll remember that conversation that you're saying there, Simon, which is you explained to me about putting money in now, and now I have this pot of money that I can look at.
Well, see, Simon's way more qualified than me, because when I used to sell a pension, I used to tell the client it was like baking a cake, right? And it says that the size of the cake, honestly, Rebecca, I used to tell them, the size of the cake was in proportion to the ingredients that went into it. And the ingredients that went into it would be the amount of money you put in, the amount of money your employer put in, actually the amount of money the government can give you. And if you're extremely wealthy, the government will give you more tax, so you can get up to 45%. And the final ingredient, the piece to the resistance, was Chris and the fund manager, right? But actually, you have to start baking the cake early, and you need to plow the ingredients in early, because if you plow them in early, you won't have to put them in later, and you'll have a huge big cake. And all that happens at retirement is you just slice the cake up in proportion to the events you want in your life. So you can get 20. So I used to draw a cake and say, when you get to retirement, we'll take 25% of it, and we'll give that to you tax free, and all sorts of drawings and analogies. But it goes back to I love what Simon's saying about simplicity. It is a savings plan for your retirement, but to me, it's a big cake. It always has been. I can't get the cake out of my mind. And I hope the viewers, you know, we've got more technical than true potential, because you've got goal set and then you've all sorts of stuff on your client website. I think the client website's brilliant, by the way. You know, Simon can set a goal in there, and that goal, you know, and to me, this is all like a plane journey. Like, I see EasyJet's going to start up again and put a face mask on and get me back to work in June. However, you know, this is a journey, right? You'll have some volatility on the plane journey, but this is a journey to retirement, right? And what the goal setting and True Potentials technology allows you to do is set the end goal, the destination of what Simon wants you to get. And then, you know, every single day you can see how Chris is doing for you. Every single day you can see Impulse Save, which is the ingredients going into it, right? And I've seen nothing like this software that Rebecca said that all her young people can get. You can actually track and monitor the journey. And I remember doing a roadshow about 10 years ago, where I went for 2 weeks telling people about a new piece of software, you know, and actually what I was describing already invented was speed traps, where you could monitor speed and stuff and know when you're going too fast. And David let me talk about it for 2 weeks and then told me, you know, that exists there. So, you know, you can always trust your colleagues. But to me, that's a pension. It's all those ingredients and get it started early is the way it works.
I think as well, just moving to the opposite end there. So we've kind of just talked about the saving side in terms of beginning the journey to retirement, but then when you get to retirement, there's different types of pensions as we know, in terms of we have a defined contribution pension, which is what we're seeing people saving into via auto enrolment. But you've also got the defined benefit pensions that we've been actively involved in looking at over the last couple of years. And I don't know, Simon, if I can just jump to you on this question, because I know you're qualified in terms of giving advice on these types of products. Can you just explain a little bit about these types of products and why potentially clients are coming up to you and asking you about whether it's an option to transfer these or if it's in their right interest?
Sure, yeah. So it's quite a big area, this, but what I am finding is that a lot of people don't realise that you've got a choice when it comes to your taking your retirement benefits from a final salary or defined benefit scheme. So many people will just, if they've been working for because I live in York, Nestle is a big employer in York. So a lot of people will just take their Nestle pension, for example, without knowing that there's another option. Well, there is. You can, or Nestle in this example, will offer a transfer out of that scheme. So option one is Nestle will give you, say, £20,000 a year for the rest of your life that is inflation proofed, but it will die with you or you and your other half. There's another option that never gets explored quite often, where Nestle will say, well, you can transfer out of the scheme and they will offer you called a cash equivalent transfer value, and you can transfer that into your own private pension scheme. So, and it's weighing up those options, and that's where you need advice. It's not right for everybody, but you don't have a guaranteed income if you transfer it out, but you do have more flexibility, and you might get offered 30 or 40 or sometimes 50 years worth of income up front. So it's probably one of if not the biggest financial decision you may have to make. So if it was me, I would want to certainly know all the options and make an informed choice. And that's what I say to people. You'd almost be mad not to look at the other option. Because, you do that in any other walk of life. You'd look at all the options and make your choice. If you're buying a car, you look at all the various options of buying it outright, second-hand, leasing, BCP, whatever. And if you're getting, if they make a good offer, so all different schemes make different offers, but if they're making a very generous offer 30, 40 times, then it becomes right. It almost sways you slightly one way, but it's not. It's a very complicated piece of advice. And as Earl was saying earlier, one of the big changes 2015 that came in was that if you do transfer out, it means that you can leave the pension to anybody you like. So typically it could be a neighbour, but typically it's your children normally, or other family members, but you can leave it to them rather than it being lost. And that was the big bugbear with the old term pension, is that you could work all your life, receive 2 payments, and then if you die, well, that was a good deal then. So you lose out big time then, and your family lose out as well. Whereas upon a transfer, should you be unlucky enough to die early, well, at least the money gets passed on to your family. It's not lost. And as Earl again was saying earlier, it's not part of your estate, so it's a very tax efficient way of passing it on to your family. But also, it can pass on to the next generation and the next generation, and so on and so forth. And because the figures that have been offered are so big, it can last, obviously, a long time if it's looked after and you take advice.
Yeah, it becomes
so worth reviewing.
Yeah, definitely. I think the death benefit side is something that a lot of people are sort of concerned and want to understand. Pensions have become a good product, a very good product for inheritance tax planning, with it being exempt, but also the fact that it could be could actually be worth more than your actual house. I think just talking about the final salary pensions, I'll bring Chris in, because when Earl started talking about cakes, he was wanting to get in there. I'm not sure why, but Chris, I don't know. You talked about we were talking about gilt yields before, and we know that the valuation of a final salary pension is typically related to gilt rates, in terms of if they go down, you see values go up. So obviously, I don't know, how will that affect it?
Yeah, sure. So basically, defined benefit schemes by their nature tend to be low risk. So that means that they invest in low risk assets, such as UK gilts. So UK gilt yields are basically seen as a proxy overall for the investments within a defined benefit scheme. So what you've seen is obviously you've got interest rates in the UK at 10 basis points. You've got 10-year gilt yields right now at 17 basis points. And just to give you an idea of sort of how low that is, if you would have gone back to 2008, what was the kind of long run historical average for gilt yields? It was probably about 500 basis points, so 5%. What you've seen is gilt yields slowly come down as interest rates come down overall. But what does that mean for people who are thinking about transferring out of the pension scheme? Well, actually, when gilt yields are very low, it means that defined benefit schemes become very expensive for the company to run. So they keep on having to pump more money in to basically meet those liabilities to pay out those pensions. And that means that they want to get that pension off the balance sheet. And that means that they're willing to pay out higher multiples, which is it's exactly what Simon was saying, 30 times, 40 times. I mean, it's a pretty incredible time if you were thinking about transferring, when you just see those levels of multiples coming through. The reality is interest rates are exceptionally low, and there's a really good reason for that. Will they stay at this level forever? No, they won't. At some point they will start to go back up. Therefore, right now feels like such a good time to take advantage of that.
Yeah, I think so. As I said, I didn't think I'd seen negative gilt yield rates.
Neither did I. Yeah.
I remember talking to clients and advisors about a year and a half ago, saying, well, they're probably not going to go any lower. And they have. It's just a real unprecedented time, I think, Chris.
Unprecedented. It's a good word, isn't it?
Yeah, we'll carry on using that word. And I think from when it comes to requiring, when you get to that end stage of retirement and you're needing income, or you want to start looking at your options, Rebecca, where are we from a head office point of view in terms of what options are there for clients that potentially want to start exploring their options and going into retirement?
So clients have got a few options of how to do that. It'll start initially, they'll call up, they'll speak to their care team, and we'll speak to them about which route's going to be most appropriate for them. There is always the option of speaking with an advisor. They can take advice from one of our head office advisors as to how much they should be taken out of their pension at that stage and ongoing as well. They can, if they know exactly what they want and they don't want to take advice, there's an option to have a telephone call and just give that instruction directly. Or we've actually just this week launched a online service where we can enable it via the client website for the client to go through. They'll get all of the information that they need throughout the process, and say, this is how much I want to take out of my pension moving forwards.
Great, thanks, Rebecca. And I think just from a final point of view, the questions that I'm asking Simon and Earl this question: how important do you think, from the client technology perspective, has it been during this sort of period of uncertainty? Is it, Sam, you've obviously had many clients probably log in, Earl, you've spoken to probably lots of advisors. How important has that technology been? Simon, I'll start with you.
Yeah, thank you. Really helpful, yeah. It's funny because some clients, when I've spoke to them, have said, well, a lot of clients actually said they didn't look, because obviously they hear the news, they know that the investments have gone down in value, like everything has, and so many clients said they didn't look, but then eventually they have looked, and every single client has said, oh, not as bad as I was thinking. I think people have assumed that, they've lost 2/3 of the money or half the money's vanished, when it hasn't. It's not been that bad at all. Typically, I found that they might have lost. I know it's a lot of money, but at the worst of this, maybe a 20% drop if they're in like the balanced or medium sort of risk area. But then there's been a 7, 8, 9% recovery. So you may be only down, but down maybe 10, 11%, 12% perhaps. And so it's not as bad as people were thinking, considering what's happened to the economy and the FTSE and what have you. But the fact they can log in and see it has been great in general. People have been pleasantly surprised, I think, in some cases. But the fact they can do that at any time on the phone, yeah, and it frankly, it frees me up as well to be able to carry on doing my job, because if they had to ring me to get that, or ring True Potential to get that information, I'd never get any work done, because I'd be constantly fending phone calls. So that technology works it helps me, and it helps me with my own pension, but it helps clients get that information. So I think that's great, and that is something I found where clients have, well, a lot of companies haven't been as, if you like, as forward thinking or have the technology available for this. So you can't get through on the phone. If you have to ring up, you can't get through for evaluation. So it really has been exceptionally good, I would say, that service, that facility.
Brilliant. Yeah, no, I've heard from a lot of advisors about the fact that we've been fully operational, True Potential, working from home with no issues from a phone system point of view. I think technology wise, I know, Rebecca, you had to deal with a lot of that. You look after a lot of customer care agents, and that's been pretty seamless, hasn't it, in terms of just setting up and being able to sort of work in the usual way from home.
Entirely seamless, Jamie. So as the markets were sort of particularly shaky earlier this year, we already had agents working from home over the weekends and things like that to try and extend the service that we had to clients. So we were already well prepared, well equipped. We tested it, we knew that it worked. Our call answer times on average are about 15 seconds for our customer care team to get through. So it's pretty incredible when you look at some places you can't get through, or you've got really extended wait times if you can. Live chat, video chat services all still working. Only difference is you've got somebody in the front room as opposed to the office now. Definitely.
I think I'll bring Earl back into this as well. We'll wrap it up. Earl being the experienced member, and also
you have to stop saying that, Jimmy.
And clearly, I'm very impressed by your cake making abilities. And actually, I made a few cakes myself, but not to your standard, I would hope. But Earl, we obviously have a lot of advisors listening in, a lot of clients that listen to in. From your experience, what would your sort of top tip be for one for clients and one for advisors when it comes to savings and encouraging that?
Look, I've just listened to the experts on the panel here, and and actually it actually makes me feel quite proud. When me and the partners, David, Daniel, Neil, and Mark set the company up, we had a mission statement which was to revolutionize the way we deliver wealth management to the consumer, right? So everything in True Potential is about the consumer and the clients listening today. And that revolution was about taking modern media and giving them the information 24/7 when they wanted it, right? And what I see from hearing from Simon and Rebecca is brilliant. A client can log in. Now I know when the market goes down, they don't want to log in, but that's psychology, that's fear, right? I got a fantastic text the other day from a client, John McAuliffe. You remember John?
Yeah.
Right? He took the time yesterday to send me a text message to thank me and Chris and True Potential. As Simon said, we'll give him that choice about what to do with his pension. But B, he said, look, I've just logged in, Earl, and I'm over the moon because I've been watching the news and watching the stock markets, and I know it's down a bit, but I've worked out it's down 7%. So the actual, what Chris and the team do in diversifying, and spreading the risk is working for his pension. He understands it's down, right? I text him back and says, time to put a few more quid in, John. You're getting it at a discount. But I would say for clients is you're in it for the long term. When you've got somebody like Simon advising you, Rebecca looking after you, and Chris looking after your money. Get your money in there. The one thing that's missing over the years for me that's gone a wee bit is the regular savings. So all the money in the industry now was probably built up over the years because people were advising to do regular premiums, and it's getting people saving again. This is why I think Rebecca and what her team do in auto enrollment is brilliant, getting young people saving, right? But you have to get into a cake or a long-term savings vehicle because we're not allowed to call it the pension anymore. Right? The tax benefits are brilliant. And from an advisor point of view, I think you have to get technology, right? I think what we're going through at the moment, Jamie, is going to change. So if you look at Marks and Spencer's a day ago, who've come out and said they're now saying the shopper has changed, right? They're going to have to look at it. Banks are looking at it. Everybody's going to look at it. But Simon's sitting there quite chuffed, because he's just after saying exactly what I love to hear, which is if he didn't have the technology, he'd be overrun and he wouldn't be allowed to do his job. So I'd say to every advisor, not with True Potential, you need to call me because I'm running Insight Days, so I'm plugging them now too. Right? You need to have a look at this technology. You need to have a look at these funds. You need to have a look at how Rebecca looks after clients when you retire, because you're missing out big time on this technology. And this is now coming to the forefront, right? Without technology, I think financial advisors will struggle to look after clients, right? The most unique thing in the future, getting advice, because there's less advisors. There's going to be less Simon. Simon's going to be sought after so much. Rebecca's going to be sought after too. I doubt if they'll seek me out. They'll definitely seek Chris out to see what he's doing with their money. But you need to get technology. And for clients, you need to get into these investments. Get it on an iPhone so that you can check on it and see how it's going. But if you have a look at Chris's investment strategy, based on that text I got from John, it's delivering what it says on the tin.
Yeah, it's funny you say that, Earl, because many of my friends I'm speaking to say that, I have spent less money in lockdown, but I know my wife has definitely spent more of my money during lockdown, because and I've got more jobs to do. I think on Saturday morning I had a full garden furniture set to put up that I had no clue it was coming until the morning. So I think that's quite a common thing that's going on. I think it's similar to your wife, Earl.
Well, I've just realised this is going live, so it's okay for my wife to keep spending the money. I'm not criticising her. I don't have a problem.
Can we make sure we put that as a headline and share that with everyone? Okay. All right, everyone. Well, we'll just quickly before we're finished, I think it's a bank holiday weekend this weekend. So it's sunny outside. It's definitely sunny in Bladen, where Rebecca's from. But I think we'll start with you, Rebecca. You got any plans for the weekend?
Not a lot. We normally, for the end of May bank holiday, we normally have a big barbecue with lots of friends over, but of course this year that's off the cards. We're actually, although the restrictions have lifted a little bit, we're sticking to them. quite a bit. So a few nice long dog walks, and that's about it for us. We've got a few sort of Zoom phone calls booked in and things like that. So a nice and quiet one.
Yeah, I don't think I've ever done as many quizzes in my life since this lockdown.
I'm all quizzed out. We've got a family quiz tomorrow, and it's they're becoming overkill, aren't they? There's so many.
I'm sick of coming second, to be honest. Chris, what about yourself? You're in London at the minute, aren't you, Chris? I think.
I am, yeah. Unfortunately, my girlfriend broke her ankle
a
couple of days ago. So this weekend I'm going to be the sort of designated house slave.
That wasn't the cake.
Is that just normal, Chris?
It is fairly normal, yeah.
You're a good lady.
Yeah, so lots of tidying and cooking and things like that.
Well, make sure you're looking after her, Chris. Make sure you're looking after her. Plenty of glasses of wine. Let her put her feet up. I'm sure that'll.
Yeah.
And Simon, are you any plans for the weekend? Are you visiting one of them places behind you? Probably not.
No, unfortunately not. No, I've got a couple of games of golf booked in now. We can go and play golf, so that'll be good. The lawn needs a mow, and a couple of long dog walks, I think. And I've got a Zoom quiz with some of my friends on Sunday night. Another one, but it keeps in touch with people, doesn't it? It's quite good. So I've got. We pick a category each week, and we do 5 questions each of a different category. It's a bit of fun. So I've got film quotes this week, so I've got to think of 5 film quotes.
Should be. Sounds like fun.
Busy.
Sounds like fun. And last but not least, Early, what's going on in Ireland this week? Actually, should I ask that? What's going on in the Mr. Glasgow's house?
Well, I had a funny enough, Jamie. I looked at the rules last night that the Stormont government just released. They released a video on what you're allowed to do. So, my choice this weekend is I can visit the dump. That's open. I don't play golf or tennis, so I can't do that. I can have a drive-through cinema, but we don't have one over here that I know of. And there's actually a drive-through church. So if you can find a church that has a drive-through service, we could maybe do that. We can meet in 4 to 6s. But I don't have 4 friends, so I'm not going to do that either. So I'll possibly just go outside, clean the garden, go and look after the parents, and visit the dump. I think probably that's the highlight for me. We're allowed back into the dumps.
You're not bringing the parents to the dump, Earl, are you?
No, Jimmy, I didn't say that. My mother-in-law is fantastic. Stop that.
Definitely watching this video. Well. Excellent. Well, thank you very much, everyone. Hopefully that was a good sort of podcast for everyone. Thanks to all the viewers. We'll be back next week. Thanks again. Thank you, everyone. Thanks.
Thank you.
Bye.